not stocks. Well, let's move right on and talk about stocks, in fact, because Feroz, you've got a very interesting point, investing in mutual funds versus investing in equities. Now, we've had quite a few discussions which have been fairly similar, and one needs to really weigh this from a perspective of how risk averse the investor is as well. So for someone, say, with a fairly who isn't who doesn't have a very high risk profile, what exactly would you advise, and what's the easier option?
See, of course, as you rightly indicated, that this debate of whether you should have mutual funds or direct equity in your portfolio has been a perpetual debate in a client's mind, and the dilemma doesn't seem to be ending. But having said which, I think it's very important to understand one is risk, the other is capability to generate consistent extra return over and above the indices. When we did an analysis on the risk parameter, we realized that even in the large cap category, if you took examples of the last 1 year, there is a HDFC Bank, which is a large stock, which has gone up 41%. On the other hand, there's Sun Pharma, which has lost 27% in the same time period. So the point I'm trying to get to is the kind of differential returns you can have by holding direct equity will actually bring different points in time. The risk is going to be very, very different. Consistency becomes the most important element of investing. If you're trading, definitely direct equity is one thing where the agility is very critical, and you will have to keep booking your profits, move on to better ideas. But for an investing personal finance kind of a perspective, for larger portions of your money which need to be stable, I think mutual fund will do a better job. From the parameter of volatility, it's crystal clear that if you compare it with a mutual fund like ICICI Value Discovery has generated 11%, but these two stocks which I illustrated for the purpose of making my point have a differential return of 70%. So if you went wrong, the implication of going wrong on a stock is going to be large on your portfolio, and these dents will make sure that your goals which you have set for yourself might be in question, and that's not one thing which you would want to do in the aspiration of making a few percent here or there more. So that's point one. Point two is when you have to beat a mutual fund using stocks, you will have to buy stocks which beat mutual funds. When you look at the 50 stocks of Nifty, only 40 to 50% of the stocks are able to individually beat mutual funds. So if your probability of picking up those stocks is going to be 40-50%, any strategy which has a 40-50% probability is not a good strategy to pursue from a long-term perspective. And thirdly, I think, again, if you look at it from a diversification perspective, I think the outcomes are going to be so dramatically different in a mutual fund that the risks, for example, if you look at last Wednesday, where PSU stocks and private sector banks had a very large difference in performance, but Nifty just moved 88% and mutual funds 88.88%, and mutual funds moved 0.5%. That exemplifies the risk mitigation diversification brings to table in a mutual fund. So it's a clear hands down win for a mutual fund, in my opinion, from an investment standpoint. Of course, trading direct equity would be a better platform.
Absolutely, Feroz. Thanks for putting that into perspective. For us, of course, selecting the right stock is a difficult job, and perhaps it would be better to go for a mutual fund, especially if you don't have the inclination or the time to invest in stocks. But